Good morning, good afternoon, and good evening, wherever you are in your beautiful country. This is a new episode of Pair Trade Finder Pro, where we are analyzing the pairs ESE and KSI. The system triggered the signal end of June, and the exit was on July 19th. These are the tickers for Esco technology and MKS instruments. Uh, And in this trade, we are going to learn how to properly let a trade run, even if methodology that we have explained in the last episodes, specifically with the 1.7 standard deviation rule, has been accomplished. But if for whatever reason we think that the pair still have some potential and we prefer to let the trade run, how to do it properly. But as we always do, let's check the different parameters on our cheat sheet that will explain at first instance why do we took this trade. And first thing to do is to check news. This is so important factor that we will never give up pointing it out. And in order to do that, let me go to the Nasdaq website where you can find both stocks in a way that is very easy to identify the dates we're speaking about. So in MKSI, around 30th of June, there's nothing relevant that we can see around, apart from the fact that maybe some analysts were specifying that this is an interesting stock in terms of its dividends. But apart from that, nothing that could affect substantially the price. Esco is a different story. In Esco, you see the dividend payment occurs on the 30th and contributed to build the signal. In reality, the contribution was not that big because the day before we were already at 2.61 standard deviation and grew up to 313 that day. And even if the dividend was against us, because Esco was short, it didn't hit our P&L because the payment and the market reaction to it was previous to our orders to the broker, because the signal, of course, reached us after the payment, the dividend payment. In any case, to be coherent with all our narrative, we are going to mark that with a yellow. So dividend dates is a yellow. Related to earning dates, what we have is that MKSI is announcing earnings on the 27th of July. So that gives us 27 days of trading, which we consider slightly tight, but still enough. ESI earnings already happened on the 9th of June, so we mark this box with a green. Pair momentum is the next parameter we're going to analyze. So I go back again to the charts, and they are apparently not looking that good, as there is an upward trend last 3 to 4 months. But if we look closer look to the backtest ratio curve, what we observe, the pair has been trending down almost for the 2-year period. So even if not in the best condition, we think that the upward trend that we observed last month is kind of abnormally in the history of the ratio. So there is a possibility of reverting back. In any case, once again, we have to mark this pair momentum with yellow. Ratio chart from the percentage from mean and the standard deviation charts show the signal above the resistance level. Let me show you here, is where you can see it easily. So you can probably determine that this is a resistance level. Our signal was slightly above, so we think that reversion to media is something very possible. And if we focus on the ratio chart itself, we observe that when the signal was triggered, the gap between the price, the ratio price, and the moving average is very big. So the possibilities of reversion to media increases substantially at this point. So because of that, we are going to mark this box here with a green. Standard deviation at the signal entry was 3.11, so that is below our threshold, which is 3.5. And once again, if you take a look at how the standard deviation was built, you can observe that it was formed in a kind of slow motion until it reached the 3.13 that triggered the signal. So because of that, we're going to mark this box also with a green. Rsi chart is quite interesting because what we can observe in the ratio chart and in the Rsi chart is the fact that previous to the signal, the ratio was in an uptrend situation while the RSI was going down. So price going up and RSI going down is what we call a divergence, and it's a clear sign that the reversion to media has a lot of probabilities. So with that, we mark the RSI box with a green also. Correlation and co-integration. We take a look to those parameters on the backtest menu, and what we see is that co-integration was 0.76, but at the time where the entry was triggered by the system, it was above 0.9, and correlation is 60%. So the combination of these two parameters is good enough, in my opinion, to go ahead with the trade. So we will mark both in green. Again, co-integration, when the signal was triggered, was at 0.90, which is above our threshold. Volatility box, we go back again, and you can observe here that the volatility was slightly high, it was 3%. We would like to see this below 2.5, and it was trending up. So this is clearly a yellow at least, and what we are going to do is also reduce size. So instead of going all the way with a 10,000 per leg bet we normally do, we're going to go with a 5,000, so half of it. We consider that 10,000 is too risky for this trade. We mark that also with the yellow, as already mentioned, and the last box we want to analyze is CAC-R and drawdown. In the backtest menu, CAC-R is 14.5 and the drawdown is 5.11. So CAC-R is higher than the drawdown, and that's what we like to see. And in this case, the CAC-R, the compounded annual growth rate, is 3 times the maximum drawdown. So that is a very, very good balance. And this is one of the most fundamental reasons why we took this trade. Additionally, there are some other parameters. I want to give you some insights on them because I think they are quite interesting. The very first one is that if you observe the P&L curve, what you see is that the trending has been always upwards. That means that there is 100% of trades winners in the 2-year period of history. There is 5 trades, which is a very good number because it is above the minimum we ask, that is in 4. And it's not only the fact that the net profit is 1,500, more than 1,500. It's basically the fact that the net profit per trade is about 250. It is 311. That is a very good number for a 5,000 leg. And maybe finally, the average days in trade, it is 70.2, slightly high. We like to see this around 14, maximum 15. But keep in mind that, as we already mentioned, we have 27 days for the trade to run. So we still have 10 days as a buffer in order that this trade goes beyond its average days in trade. So with that, we mark this box also with the green. And the overall conclusion is that this is a trade we're gonna take. We're gonna try to use some precautionary measures, but we go ahead. And let's see how did it evolve. Once we get the signal, it begins to converge pretty fast. At this point, on the 12th of July, the 1.7 standard deviation rule get accomplished. And at this point, normally I should have exited the trade. But as already mentioned at the very beginning, we see some potential on the trade, so we are gonna let it run. The way we are gonna do it is by setting up the alerts field here, mark it with a tick in order that if the system detects that the P&L of the trade goes below $200, it will send us an alarm via an email and a sound. So if that happens, then we should immediately exit the trade. This is basically setting up trailing stop. Trading continues evolving. Then it grew up to more than 400, but then it began to revert back. And it reached a point where almost our stop loss was touched. Hopefully, it began growing up again, and we finally end up with a standard deviation of 0.93 with a profit of more than $460. So very profitable trading because there's only 12 days in the evolution of the trade. So remember always, if you're gonna let the trade go beyond the risk management tools we already mentioned, at least place your stop loss and be very tight to them. And with that, the only remaining thing on my side is wish you a very good trading and see you in the next episode.